Straddles and spreads are option strategies designed to express specific market views while controlling risk and capital requirements. Unlike covered calls, protective puts, and collars, which combine options with underlying assets, straddles and spreads are primarily constructed using options alone. These strategies allow investors to isolate expectations regarding market direction, volatility, and price ranges. Their flexibility makes them valuable tools in portfolio management, hedging, and tactical trading. Understanding their structure, payoff profiles, maximum profit and loss, break-even points, and investment objectives is essential for candidates because they illustrate how combinations of options can produce customized exposures that cannot be achieved efficiently through direct ownership of securities alone. A long straddle consists of purchasing both a call option and a put option on the same underlying asset, with identical strike prices and expiration dates. The strategy is designed to profit from substantial price movements in either direction. Because both options are purchased, the investor pays two premiums, making the total premium cost the maximum possible loss. If the underlying asset experiences a significant increase, the call generates profits that exceed the premiums paid. If the asset declines sharply, the put becomes valuable and produces gains. Therefore, the strategy is not based on directional expectations but rather on the anticipation of high volatility or major market events. The payoff profile of a long straddle resembles a V shape, with losses limited to the total premium paid and profits increasing as the underlying asset moves farther from the strike price. Two break-even points exist because the strategy can profit from either upward or downward price movements. The upper break-even equals the strike price plus total premiums paid, while the lower break-even equals the strike price minus total premiums paid. Since the position benefits from volatility, it possesses positive vega and gains value when implied volatility increases. Long straddles are frequently employed before earnings announcements, regulatory decisions, or other events expected to generate substantial uncertainty and price movement. A short straddle is the opposite position, involving the sale of both a call and a put with the same strike and expiration. The investor receives premiums from both options and profits if the underlying asset remains close to the strike price. Maximum profit equals the total premiums received, which occurs when both options expire worthless. However, the strategy carries significant risk because substantial price movements in either direction can generate large losses. Short straddles therefore represent a volatility selling strategy. Investors implementing this approach expect market stability and declining volatility. The strategy has negative vega and benefits from the passage of time as option premiums gradually erode. Spreads are option strategies involving simultaneous long and short option positions designed to limit both risk and reward. The most common examples are bull spreads and bear spreads. A bull spread expresses a moderately bullish view by purchasing an option with a lower strike price and selling an option with a higher strike price. The long option provides upside participation, while the short option reduces the initial cost. Unlike a simple long call, the spread caps potential gains at the higher strike. Consequently, the strategy sacrifices unlimited upside in exchange for lower capital outlay and reduced risk, making it suitable for investors expecting moderate price appreciation. Bull spreads can be constructed using either calls or puts, but their economic objective remains the same. The maximum profit occurs when the underlying asset reaches or exceeds the higher strike price at expiration. Maximum loss is generally limited to the net premium paid for establishing the spread. Because risk and reward are both bounded, bull spreads offer a more conservative alternative to outright option purchases. They are particularly attractive when investors hold a positive but not extremely aggressive outlook on the underlying asset. The strategy allows participation in expected gains while controlling downside exposure and reducing the effect of option premiums on overall profitability. Bear spreads represent the opposite directional view. They are established by purchasing a higher strike option and selling a lower strike option, creating a position that benefits from declining asset prices. A bear spread limits both profit potential and risk, making it appropriate when investors expect moderate declines rather than dramatic market collapses. When implemented with call options, the strategy often generates an initial premium inflow, while put-based bear spreads typically require a net premium payment. Regardless of construction, maximum profit occurs when the underlying price falls to or below the lower strike price. Break-even analysis remains important because profitability depends on the extent of price movement relative to initial premiums. For candidates, straddles and spreads demonstrate how option combinations can transform market views into precise risk-return structures. Straddles focus primarily on volatility expectations, allowing investors to profit from significant price movement regardless of direction. Spreads, in contrast, express directional views while limiting both gains and losses through offsetting option positions. These strategies highlight fundamental option concepts such as intrinsic value, time value, volatility sensitivity, maximum profit, maximum loss, and break-even prices. Mastery of their payoff structures enables investment professionals to design targeted solutions that align with client objectives, market expectations, and risk constraints, making them indispensable tools in modern derivatives-based portfolio management.